This video is going to spend some time diving into the value of having a strong financial and investment strategy when it comes to various market cycles. Now, over the last 8 weeks, we've experienced the tariff tantrums or the tariff turmoil, and a lot of portfolios have taken a punch. And today I want to spend some time on how to manage your portfolio through challenging economic and market cycles, and then come out on the other side stronger than ever. This is something that I see with a lot of my clients, especially those younger clients coming to me for the first time. They usually have been through some sort of calamity, whether that's a market drop, a job loss, or something like that, and they're looking to find direction. And when I look at building portfolios, I want to do that with intention. I want to build a plan and have the investment strategy work for you to achieve those goals, to achieve those aspirations. And that's going to then guide how we put together the portfolio. And then I'll give some context to what we do at 4 Points Wealth to help our clients weather the storm and come out at the back end much stronger and take advantage of some of the downturns. I look at this with a lot of my clients who are a lot like myself, very active, very involved in their lives, and you would never go to the gym without some sort of a plan, because your results are going to be inconsistent. You're not going to know what you're really training for, and there's just going to be no intention. So you might go and lift some weights, but you're not really going to see your body change, or you're not really going to see the impact of weight loss or getting stronger if you have no plan. Or if you're building a house, we just went through this last year when we were doing a massive remodel on our home. We went through all the steps, the planning. You go through the city, you go through your architect, you go with the GC, and there's all these steps. If you just went flying by the seat of your pants, the result would not be what you had hoped. If you do the planning, guess what? You're going to likely, or more likely, get the result you're looking for. So whether that's building a house, going to the gym, or even making dinner, think about that. If you don't have the right ingredients, how are you going to make the dish that you're hoping to make? These are all some of the things that I think about when it comes to investments. So I use that as the analogy to understand how we do this. We don't just throw together a bunch of investment strategies, funds, stocks, bonds, whatever. What we do is we do that with intention. We build it from one step to understand your goals. We do the planning, we learn who you are, what your values, and then we build that portfolio that's curated to your specific situation. And in today's economic markets, it's an incredibly dangerous game to do it without any sort of direction or goal or strategy in mind. And I understand there are a lot of things going on in today's world. It seems like we're always one tweet away from the next bit of chaos. We saw this with the tariffs. We've seen this in other instances as well. And we're seeing a lot of changes in today's environment. Scary headlines. What's going to happen with the economy next? Is there some concerns that we have there? I get that. This is a perfect time to get the investment strategy dialed in, because that can allow you to weather the storm and manage through the downside, or even take advantage of the upside, whatever your preference is. But that's what we do at 4 Points Wealth, is we help our clients through these experiences. And so over the last 6-8 weeks, where we've seen a lot of turmoil in the markets, and then we've seen that recovery happen, our clients have been sitting there. The reason that I'm fine is because the conversations that I'm having, yes, they're a little bit panicked. Yes, they might be a little bit concerned, but we go back to the portfolio that we built for. We go back to the financial plan. We go back to some of the details that we talked about when things weren't as chaotic. Through that experience, it's been reaffirming to know that the process, strategies, and tactics we use at 4 Points Wealth are working well for our clients. Right now, we don't have our crystal ball. We don't know what the future holds. But when we build portfolios with intention, we're not using the hope investment strategy. I hope it turns out okay. We're using intentional approach that is geared to your risk profile, whatever that may be. But we want to build a portfolio that is in alignment with what you're ultimately trying to achieve. So when we look at that, we look at a few different aspects. And when I talk with clients, I start to help them understand what goes into an investment strategy. This is not dissimilar to sitting down with your personal trainer, and they're going to walk you through with, if your goal is to lose weight, well, these are the different exercises that you might use. This is why we're doing this movement. This is why we're trying to get tempo. This is why, we want to raise your heart rate. These are different things to consider when we think about the investment strategy as far as building that out. And just like you would do in the gym, you want to understand the pieces and parts that are going into it. So the first thing that I look at is strategy versus picking investments. Now, when I look at this, I think of, and I've seen this a number of times. Client comes to me, they've been doing it themselves for quite a while. They've had reasonable or at least okay returns over a period of time. And what we see is that's pretty much across the board. I then ask them, well, what's your approach? What's your strategy? And they kind of look at me dumbfounded, like, I don't know what you're talking about. We open the portfolio up, and sure enough, it's a mixture of some individual stocks. And what I find is that they're stocks that are usually associated to their industry. So it's like, oh yeah, I know this supplier and they are a really good company and they also are publicly traded, so I'm invested in them. Or they've heard that index funds are really great, so they might have an SPY or something like that. But then this is where it gets really interesting, is they might have some interesting overlap. So you might see VOO, which is also an S&P 500 index fund, right next to SPY. And then you might ask, what's that all about? They didn't realize they were invested in the exact same thing in two different funds. I don't want my clients to feel stupid, but it's to educate and help them understand that ignorance is not bliss. This is where we need to be intelligent, be thoughtful, take the right steps. So it's not just about picking winners. It's not just about finding the next Google or the next Amazon. Those things may happen, but we can, using our approach, which I call core and explore, we use a core approach that builds from the base foundational structure of an investment. We look at your goals, your timeline, and your risk profile, and we help your investments work for you versus the other way around. We want to take the guesswork out. We want to do it with intention, and deliberate steps that are in place can be very helpful and give you a little bit more certainty when there is so much uncertainty. The second thing that we do, another philosophy that we approach our client portfolios with, is using what I call a goals-based approach. I use goals-based approach as a time-bound approach to building an investment strategy. Most people understand that there's growth, income, or aggressive or conservative. Those are two ends of the spectrum. But oftentimes people will come to me, especially those folks in their 50s, they're like, well, my timeline is only 3 years or 5 years or whatever the time frame is that they're going to retire, and they need to take a lot less risk. Sure, over time you should take less risk, but if you're in your 50s or whatever that looks like, your likelihood of living until you're 85, 90 years old is highly likely. So you do need to have a lot of growth. Just because you're close to your 60s doesn't necessarily mean that we need to remove any risk and you got to go 100% bonds. When a goals-based approach is, we start to look at, when does this money need to be used by? So if you're 40 years old, you want to build a house as an example, and you've got to have some sort of a down payment for construction, and you need to do that in the next 3 to 5 years. What I recommend to my clients is, whether they're 40, 45, 50, even though they're younger, we actually need to reduce our risk because we don't know what the next 2 to 5 years is going to look like in the market, especially if those goals are within 1 to 3 years. So oftentimes what we'll do is low risk investments that don't necessarily have the upside, but guess what? They don't have the downside. So when you ultimately need to use that money, it's going to be there for you, and you don't have to fret and worry over the ups and downs in the market. If you look at longer term money, so let's say you're in your mid 40s, you've got 20 years till retirement. You're saying, I've got 20 years, my 401k, this money's going to be built for retirement assets. I can take more risk, and I'm adding more money to that every single paycheck, every single month. So then you can take advantage of those downturns. That's another thing that we did with a lot of our clients that are younger. We didn't stop when we saw the market going down. We didn't stop the monthly contributions going into their portfolios. We made sure your dollar cost averaging through the down cycle, and now we're seeing upside gains on the back end because we got to buy in at those lower valuations. Goals-based approach, always starting with the end in mind, understanding what's the ultimate goal, what did this money need to do for you, and then building it out that way. Now, moving on to our investment philosophy for how we structure a portfolio. As I mentioned, I use the core and explore method or framework. And this approach has been an awesome way to help our clients understand that we're just not slapping portfolios together. And each one of our clients has their own customized portfolio. But there are some basic elements of investing that all of our clients should have. We have portfolio models that we build around these approaches. We have a way to build those portfolios across a set of models that go from aggressive to conservative. And then what we do, that's our core strategy. This is anywhere between 100% of your money that you have invested down to maybe 80%, 75 to 80%. So 75% to 100% is in a core strategy. So that's where we go. For clients that want me to do everything, they might do a full core strategy. That's fine. Do you have a higher risk profile so you can take on a little bit more risk? What does that ultimately look like? Then we can adjust them on that scale from aggressive to conservative. And then we look at other alternatives. Let's say a client comes to me, they're like, I really like individual stocks, but it just hasn't worked that well over the years. I hear it on Kramer, this newsletter I watch, this such and such show, or my buddy at the golf course. And what I find is that makes a lot of sense because the news cycle is caught up with the greatest investments of that day. They don't necessarily look at the entire picture. They want to talk about the cool, sexy thing, which oftentimes is priced at the highest. So people are buying in at that point, and then it drops from there. You might see this on social media with some of the memes they have, and this is very real. That hasn't worked for a lot of clients, but they like the excitement. We can build a portfolio that says, hey, let's pick these 3 to 5 stocks that we can use with, let's say, 20% of their portfolio allocation. And we've got the core strategy. So during certain market cycles, it's going to do certain things. We like that approach. And then with that 20%, we can kind of roll the dice a little bit if that's how you want to look at it. Or you want to do some stock picking. Or there's one way that we can do it is also managing the downside. We can use an approach where we manage the downside and give you some comfort when it comes to the volatility of the market. So that 20% isn't necessarily always oriented toward high growth opportunities. It could be oriented towards managing risk a little bit better. So it's not just taking this scattershot approach of what's out there, what's the latest news, and let's just buy investments that way. I have seen clients come to me, and what's interesting is that a lot of clients will give me their serious money and then take their fun money and invest it. When markets go up, they're apt to tell me how things are going. But as we build our relationship, they'll also then tell me, gosh, Taylor, I've got this portfolio that was doing really well. Today it's doing really not well. And again, it's usually individual stocks and the returns are very inconsistent and they're trying to find, throwing darts against the wall, and it becomes very difficult to get the results that they're looking for. Using this methodology, the core and explore, we allow our clients to have their cake and eat it too. We can adjust the size, the scope, not vastly different than maybe buying a car where you can get different models, you can get different bells and whistles. So that's kind of cool. And then the last thing that I look at when it comes to building a portfolio is this idea around tactical, passive, and strategic. Usually those things are kind of pitted against each other. It's almost like a triad, right? Tactical is buying and selling, in and out of the market, trying to catch the swings. This is focused around technical analysis. So you're trying to see the different trends in the market. You're taking advantage of the various sequences that you might see. There's so many different trends that you could look, trend lines, 50-day moving average, 200-day moving average, understanding the resistance, support, all of these technical things can be good. I've seen it where people have done really well. However, over time, the average investor just underperforms that type of approach. So I use that if we have a tactical manager. Sometimes we deploy that. In some cases, we use ways that, whether that's managing beta, there's some other things that we do from a tactical perspective, but very, very rarely, we're not buying and selling on a daily basis. In fact, we don't even think about it that way. The other side of that is passive. Passive is an approach that is buying it forever and just saying, hey, I'm gonna just hold this thing. This has really been in vogue with buying the index. And that can be fine. Don't get me wrong, that can be good for, set it and forget it. What I found is that our psychological approach and just the psychological nature of human beings is that they struggle mightily with just having a completely passive approach, because they start to open their accounts, they start to see things during challenging market cycles. look at 2022, 2018, even just the tariff turmoil that we've seen over the last 8 weeks or so, shake people that can really affect them. And then they sell, and then they try to find when it's going to get back in. And then all of a sudden they're tactical. And that doesn't really work that well. And then there's this third, and that's going to be strategic investing. And that's what we do at 4 Points Wealth, is we look at more of a macro themes of what's going on in the market. So as an example, when we saw that interest rates were moving up aggressively, it wasn't that we caught it at the perfect time, but we saw interest rates going into an aggressive upward trajectory by way of the Fed. At that point, we reduced our long-term durations of our bonds, meaning we focused on short-term bonds. So things that were maturing within the next 3 to 5 years, and even shorter than that. And getting rid of or reducing our exposure to those longer term 15, 20, 30 year maturity bonds. It wasn't hard to see what was going on because it was like the cruise ship turning. It seemed like it was happening in slow motion, and we had the ability to adjust our portfolio slightly, not just a wholesale change. Another thing that we're seeing in today's world is with all the tariff stuff, we've seen a lot of money move out of the United States and go from domestic equities to international equities. We've seen a real movement for international equities, and that's been a positive. So we've adjusted our portfolios to see what's going on. Now, it hasn't been a big shift because that trend is relatively new, but we want to keep an eye on it, see where we're going, and then we're going to readjust the portfolios along with that. So it's not making these wholesale change in and out like tactical, and it's also not just putting our head in the sand and saying, we're passive investors, we're just going to fight through the long haul. We use a strategic approach at 4 Points Wealth to allow our clients to have exposure in the right parts of the market and not get overwhelmed by the up and down day-to-day interactions of what we're seeing in the portfolio. So again, having a plan in place, whether that you're going to the gym, you're going to build a house, you're going to make dinner, whatever that is, however you want to connect it. But I think about going to the gym. If you have the goal of running a marathon or deadlifting 500 pounds, well, guess what? Those two training strategies are going to have very different approaches. Running, probably lower weights, longer runs, doing a lot more cardio. If you want to deadlift or bench press a bunch of weight, well, you're probably going to want to bulk up. There's going to be a different protocol for that approach. And so that's what I'm telling my clients right now when a new client comes to us. In building a portfolio, we want to have this protocol in place that is going to be effective, that's going to answer the questions and create consistency and reliability in our investment returns. We'll build around your needs, your wants, your desires, and your goals. That's going to be the ultimate thing for building those portfolios. So again, if you're sick of inconsistent results and feeling lost during challenging market cycles and turmoil, confused about what you're invested in and how it's going, shifting things around constantly, that's where 4 Points Wealth can help. We can do the risk profile, understand your goals, and build a strategic approach catered to what you're trying to do. We can do that across your retirement strategy, brokerages, cash, real estate, whatever that looks like, and create a more holistic approach that gives you much more control what you're trying to get better results. And that's how we can help you and be your partner.